Okay, I have started the recording. Okay, guys, I'm going to share my screen with you. Today's topic is control accounts. First of all, I will give you an introduction about what the control accounts are. So, control accounts are normally prepared for that item which a business has multiple identical items. For example, the receivables, business has many receivables. Sometimes it might be in thousands and millions as well, and the business has as many payables as well. So the business needs to know the individual balance and as at the same time the total balance of the receivables and the payables. So for the individual balance, we do have individual accounts of every receivable and every payable. And to see the total balance, we must have a total account as well. But if you prepare both the accounts, for example, if I make a sale of credit sale of $10,000, if I record this sale in person A's account and record this sale in the total receivable accounts as well, and if I carry both these balances to the trial balance, our trial balances will be duplicated. So I have to eliminate the balance of one account from the trial balance. And which one is that? It is the individual account. Remember, whenever control accounts are prepared, individual account balances are not recorded or not carried to the trial balance. They are not considered as the part of the double entries. They are just called the memorandum accounts. Memorandum, the word is excluded from the word. The word is actually extracted from the word memory, means you have to remember something. So these are the memorandum accounts, means we must memorize or we must know the individual receivable or the payable balance. So, but the part, the control account, the total account, control account is actually the total account is part of the double entry. So what we shall do, we will pass the entry with the total accounts, which is to be then carried forward to carry to the trial balance as well. So remember, whenever control accounts are prepared, only control accounts are part of the double entry. Individual accounts are just memorandum accounts. So after saying this, we will come across with two types of control accounts. One is receivable control account and the second is payable control account. We shall study both these control accounts. After completion of this topic, we shall then start from the FA1 book and we shall complete the chapters of those books. You will see when we'll start the book, you will see that almost we have studied almost 70 to 80% of the syllabus. We already would have studied. The remaining we will discuss from the book. So your FA1 will be prepared for the exam. So moving ahead with the control account, first of all, let's start with the receivable control accounts. Means this is the total account of the receivables. We will continue to discuss from the transactions. We will record the transactions with the receivables, all of the transactions which normally a business have with the receivables, and then we will record these transactions into this T account instead of recording them into individual accounts. Although in parallel, individual accounts are also recorded, we also record the transactions in individual accounts to update the individual balance. But again, as I told you, that will not be form of the part of the double entry. So if we talk about receivable control account, you know, receivable is our asset. So whenever asset is increased, the transactions are recorded on the debit side. And whenever assets are decreased, it is recorded on the credit side. So if I have to record the opening balance, I will record this opening balance on the debit side. You know, receivable always have a debit balance. If it is a closing balance, it will appear on the credit side, but it will be a debit balance, as we already have discussed in the double entry topics and recording topics, that whenever you have to close the account, the balance which is recorded on the credit side is actually a debit balance, because debit side is heavier and we just record it on the credit side to balance both the sides, but the balance is a debit side. On the other hand, you must remember that assets and expenses always have a debit balance. Whereas liability, income, and expense, sorry, capital, liability, and income. These three always have a credit balance, as we already saw in the trial balance lecture. Okay, let's assume we have an opening balance of receivable of $1,20,000. So this is the balance which is actually brought forward from the previous year. So this balance is also called the balance BF, or you might find the word balance BD. BD stands for balance brought down, or it is also called opening balance. It is written on the debit side. It means it's a debit balance. Remember, opening balance is written on the same side. Same side means if it's a debit balance, it is written on the debit side. If it is a credit balance, it is written on the credit side. Whereas closing balance is written on the opposite side. Opposite side means if we call it a debit balance, it will be written on the credit side. If we call it a credit balance, it will be written on the debit side. So we have an opening balance of 120,000. So how we create receivable? First of all, we will create the receivables with the transaction, and then we will see that what are the ways through which receivables are decreased. We will then discuss each transaction of the receivable which an organization might deal with. So coming to the transactions, let's say first of all we made a credit sale of 200,000 in this year. Although we already had an opening balance of $120,000, but we made another credit sale of $200,000. How we will record this transaction? We will debit receivable control account as increase in asset. You know, receivable is a debt. Whenever we make sale, sale is always credited because it is an increase in income, and the corresponding debit entry is receivable. But now, as I told you, we are preparing control accounts. So we shall pause all the transactions with control accounts instead of individual receivable accounts. Mr. ABC writing instead of the name of the receivable, we shall write the receivable control account. So this entry is now to be posted to receivable control account as well as to the sales control account. We shall not discuss the sales account over here, as you guys know that how to record in the sales account. We shall only be posting these transactions into control account. You see here, control account is being debited with $200,000. So what I will do, I will record $200,000 on the debit side, and the reference would be sale, credit sale or cash sale. So what I will do, I will record 200,000 on the debit side. The reference is sale. So my first transaction is recorded and is posted into the receivable control account. Moving forward to the next transactions, 100,000 cash received from customers. This is another transaction. The first transaction is the credit sale. Whenever we will make a credit sale, the entry is the same. And then the receivable are decreased in multiple ways. First of all, if they pay us cash, a receivable will be decreased. In this case, you know, as receivable is asset, we will credit receivable control account because asset has been decreased, but also we are receiving the cash as well. So cash is an asset. We will debit cash with $100,000 and credit receivable control account with $100,000. Cash will be recorded in the cash book, but we are not currently studying the cash book, so we will only post this transaction into receivable control account, and receivable control account is being credited with $100,000. The reference would be cash. So what I will do, I will record $100,000 on the credit side of receivable control account, and the reference is cash, cash received, or you can write the simple word cash. So this transaction is also posted. Moving to the next transaction, that is products returned by the customer. So this is another way our receivable might decrease. They can return the product. This is called return inwards or sales return. We have two names for this return. Whenever we make sale to the customer and the customer returns goods to the business, it is called sales return or return inwards. So as sales is always credited, sales return is always debited because it's the opposite of the sale. Then it will be recorded on the opposite side of the sale as well. So what we shall do, we shall debit sales return 20,000. But as customers have returned us this $20,000 goods, definitely our asset has been decreased. So what we will do, we will credit receivable control account with $20,000 because it is a decreasing asset. Again, this 20,000 debit side will be recorded in the sales return account, but currently we are posting all these transactions into receivable control account. So what I will do, I will credit receivable control account with $20,000, reference being sales return. So let's go and record this $20,000 on the credit side. The reference is sales return. Next transaction is 30,000 of discount is allowed to customers for early payment. This is another way our receivables might decrease if we allow them discount. As we already have studied the discount topic, discount allowed is an expense. So I will debit discount allowed 30,000 as an increase in expense, and I will credit receivable control account because my asset receivable has been decreased. Now I am not going to receive this 30,000 from receivable. So my asset is already decreased due to discount allowed. So what I will do, I will record this 30,000 on the credit side of receivable control account. The reference would be discount allowed. So this is, I have recorded 30,000 on the credit side of receivable control account, and the reference is discount allowed. Okay, moving to the next transaction, 10,000 is confirmed to be irrecoverable from customers. Well, guys, this is something new for you guys. Irrecoverable debts. These are those debts which are no longer considered to be recoverable. It means that some customer is not able to pay us now. He has gone insolvent, or a person is no more existing in this world or in this country, or has gone for a long, long time. So what we will do, we will consider that customer as being irrecoverable. It means now that debt cannot be recovered. So what we should do, we will record as an expense debit irrecoverable debts 10,000, because now we will consider this asset as an expense because we are not going to receive this amount. Normally in business, remember, if a person does not pay within 6 months of the due date, remember, within 6 months of the due date, it is considered to be as irrecoverable debt. Means he or she is not going to pay it. But if the business considers that he will definitely going to recover that amount from customer, then they might not record it as an irrecoverable debt. But otherwise, as far as the accounting standards are confirmed, or accounting guidelines are confirmed, or accounting guidelines are concerned, normally a person which does not pay within the 6 months of the due date time, it is considered to be as irrecoverable. So I will record as an expense named as irrecoverable debts. It is an expense, and I will definitely credit receivable control account because my some receivable has gone. He might not be recovered. So I will decrease my asset and record as an expense. So again, receivable control account is being credited. I will record this 10,000 on the credit side of receivable control account, and the reference is irrecoverable debt, and definitely the corresponding entry of debit irrecoverable debt is to be recorded in the irrecoverable debt T account. We shall definitely discuss this irrecoverable debts, but it is not your FA1, not included in your FA1 syllabus. It is actually part of this FA2 syllabus, that as an independent topic, recoverable debts as an independent topic. But for now, for FA1 syllabus, you must know that what is irrecoverable debt. It is actually it is an expense, and the corresponding credit entry is decrease in receivable as a credit entry. So next entry is one of our receivables. This might happen. One of our receivable paid the outstanding $40,000 to one of our payable. It means I had to pay $40,000 to Mr. X, and Mr. A was liable to pay B. So what I will say to Mr. A, please pay directly to Mr. X instead of paying B. So what will happen? One of my payable will be reduced. So payable is a liability. Whenever a liability is reduced, it's a debit entry. So what I will do, debit payable control account. Now remember, if I am preparing the receivable control account, I might also be preparing the payable control accounts. So I will pass this entry with debiting the payable control account instead of debiting the individual payable account. So the corresponding credit entry is decreasing my receivable as well, because one of my receivable has paid $40,000 to one of my payable. So decreasing my liability as well as decreasing my asset. So whenever liability is decreased, it it's a debit entry, and whenever asset is decreased, it's a credit entry. So as I am currently discussing this receivable control account, this 40,000 is to be posted into payable control account, but I will only post this transaction to the receivable control account because our current discussion is receivable control account. So receivable control account is being credited. I will record receivable pay control account as 40,000, reference being the payable control account, or you can write the word contra only. Whenever there is a amount written on the credit side of the receivable and the reference is written contra, consider this entry as also to be written in the payable control account as well. So you will find this entry on the debit side of the payable control account as well. When we shall move to the payable control account, we shall discuss that the payable control account is debited with the same amount. So if the word contra is written only, it is enough to understand that it's a contra entry. Contra means one of my receivable has paid the amount to one of my payable. Moving to the next transaction, 15,000 is charged as interest to customers for late payment. Now, what happened? Actually, I had to receive, let's suppose, 100,000 from a dollar from a customer. He actually did not pay me. I charged him as interest for the late payment. Now my receivable has been increased. He had to pay me $100,000, but now he has to pay me $115,000. So receivable has been increased. You know, whenever receivable is increased, it's a debit transaction. So what I will do, I will debit receivable control account with 15,000, and interest is my income, because interest, whenever the business pays interest, it's an expense. We already have done the interest expense transactions, but whenever business receives interest, it is opposite, it is income. So what I will do, I will credit interest income as 15,000 because income has been increased. But currently I will only post this transaction to the receivable control account. So receivable control account is being debited with reference being interest income. So I will debit 15,000 to the receivable control account, record 15,000 on the debit side of receivable control account, and the reference is interest on overdue customers. You can write interest income or simply interest would do the work. So this is my transaction also recorded. Moving, what else we can do with the receivables? That is 25,000 is refunded to a customer who had paid an invoice of 25,000 twice. Well, this is a bit technical transaction. Let's go and understand this transaction. I'm reading this transaction once again. 25,000, we refunded 25,000 to a customer who actually paid an invoice of $25,000 twice. We made a sale of $25,000, but he paid us twice. So let's go step by step. What would happen when the sale is made? We will simply, if the sale is for $25,000, we shall record debit receivable control account $25,000 as an increase in asset and credit sale $25,000 as increase in income. So this is when we made sale. Now, as customer has paid us 50,000, you see, he has paid twice, means he has paid us $50,000. So when the cash is received, what we will do, we will debit cash by $50,000 because the cash is received with the amount of $50,000. But the receivable which we created was of $25,000. So we shall only credit receivable control account with $25,000 because our asset was only of $25,000. So we will decrease our asset to zero. This is one step. But as we have received $50,000 instead of $25,000, we shall create a liability known as receivable control account $25,000. Now, first credit in receivable control account is due to decrease in asset, but the second credit in the same account is due to increase in liability. How it has become liability? Our customer was liable to pay us 25,000, but he actually paid us 50,000. Now it is our liability to pay him back. Although he is our customer, he still is our receivable. The name would be the same. His name would continue to be as the receivable control account, but Now we will credit him because our liability has been increased. Now, when the business will refund this 25,000 back to customer, what we will do, we will decrease our liability. Which liability we have created? What we will do when the cash is refunded, we will debit receivable control account 25,000 as a decrease in liability. You know, until now, whenever we have debited the receivable control account, that was due to increase in asset. But this is one exception when we are debiting receivable control account because a liability has been decreased. Why a liability has been decreased? Because a liability was created in the same account before. So what we will do, we will pay cash and credit cash $25,000 as a decrease in asset and debit receivable control account as a $25,000. Now this is the final entry which is to be recorded in the receivable control account because initially we made all the transaction, we have already recorded the sales, we have already recorded the cash received. Now this is the transaction where actually we refunded it. You see, the transaction is 25,000 is refunded to customer. So when we made a refund, we shall record debit receivable control account and credit cash. When we shall post this into receivable control account, we shall record 25,000 on the debit side and the reference being refund to customers. Now, guys, these are the maximum transactions which can be done or which you can be examined or which you can come across related to customers. Means, first of all, the balance, opening balance is actually the balance brought forward from the previous year. Then you make a sale to the customers, you receive cash from customers. Customers normally tend to return the goods, you allow some discount to customers, you record some customers as being irrecoverable. Some of your customers might directly pay to your payables, and some you will charge interest to some of the customers, and then you might have to refund some amount to the customers if they pay you an additional amount. So these are the transactions of the receivables. So after all these transactions, we shall calculate the closing balance. So closing balance, you will calculate just like as we have already learned how to close the D accounts. We will total the debit side and we will total the credit side and we will record whatever the balance is missing on the side. So you see the debit side is heavier. The total debit side amount is 200,000 plus 120 becomes 3,20,000 plus 15 3 lakh 35,000 plus 25 that becomes 3 lakh 60,000. You got it? 3 lakh 60,000 is the on the debit side. But on the other hand, the credit side is actually 100,000, 20, 30 total becomes 150, then 160, and then 40, 200,000. So on the debit side, it is 3 lakh 60,000. On the credit side, it is 200,000. So you see 160,000 we will record on the credit side to balance both these sides. So as it is written on the credit side, it is actually a debit balance. As I already told you, that closing balance is always written on the opposite side. If it is written on the credit side, it's a debit balance. So this is how we record the transaction in receivable control account. I'll now move to the payable control account because the account is same. It is for the payable, but now the entries would be opposite because payable is our liability. The opening balance would be written on the credit side. Liability always has a credit balance, so opening balance, as I told you, it is written on the same side. Mean it's if it's a credit balance, it is written on the credit side. It's also called balance brought forward or balance brought down, as we already discussed. So let's go for the payable transactions. Uh, Whenever we make credit purchase, the payable increases. We shall pass the entry debit purchases 200,000. We already have discussed it as an increase in expense. And now credit payable. Instead of writing the individual payable, I will record the entry with the total account, means payable control account as a credit entry. So I will record this 200,000 on the credit side of payable control account. So you see, I will record 200,000 on the credit side of the payable control account and the reference is credit purchase or the simply purchase. You can write the simple purchase. Moving ahead with the other transaction, we have created our liability. How it can be decreased if we pay our suppliers. So let's suppose we have paid $100,000 cash to the suppliers. The entry would be debit payable control account. We will reduce our liability. It's a decrease in liability, and we will credit the cash as we have paid the cash. So we will record this $100,000 on the debit side of the payable control account. The reference is the cash or the cash paid. So next, how they can be decreased? The products returned to the supplier of 20,000. So whenever we return the product to supplier, this is called return outwards or purchase return, because we might have purchased something which is now become faulty or something extra, and we have a contract with the customers that we might return the extra product to the supplier. So what we shall do, if purchase is debit, then purchase return is credited. So whenever we make purchase return, we'll also decrease our liability debit payable control account, because this 20,000, now we will not pay this 20,000 to the payable as we have returned the product to the customer. So credit is the purchase return as a decrease in expense, and debit is the payable control account as a decrease in liability. So I will debit the payable control account with 20,000 as a purchase return. So reference is being the purchase return. Sorry, drinking water as well. Okay, moving to the next transaction. 30,000 of discount is received from suppliers for early payment. For the customers, it was discount allowed, but for the suppliers, business actually receives discount. So discount received is an income. We already have discussed that. On the other hand, our liability will also be reduced. So I will debit payable control account with 30,000 and credit discount received 30,000 as an increased income. I will record this 30,000 on the debit side of the payable control account. 30,000, the reference being discount received. Then moving ahead, one of our receivable paid the outstanding 40,000 to one of our payable. This is the same amount, same transaction which we discussed in receivable. So receivable paid to our payable means our liability is reduced. We will debit payable control account and we will credit receivable control account. So what I will do, I will now record this transaction into payable control account on the debit side. So this is 40,000 on the debit side as receivable control, reference being the receivable control account or contra. You see, this is the 40,000 amount which will be appeared on the credit side of the receivable control account, and the same amount on the debit side of the payable control account. Remember, contra entry is always passed when the amount is same. It is not possible that I have to pay 40,000 to some of my payable, but the customer is to pay me just 20,000. So the contra entry will be passed by 20,000 only. If he pays 20,000 to my payable, I will pass this entry with 20,000 instead of with passing with 40,000, because the whole 40,000 is not paid. So moving to the next transaction, 25,000 is refunded by a supplier to whom we paid excess amount. 25,000 is refunded. This is the same transaction we already discussed. Whenever supplier pays us, what we will do, because we have paid him extra amount, now the payable has become my asset. So when the supplier will pay me back, I will debit cash 25,000 and I will credit my payable as a decrease in asset, because although my payable is my liability, but this is the exception. This is the point where I had already paid him the twice amount. I had paid him the additional amount, and now he has refunded me 25,000. I will debit cash as an increase in asset, and I will credit payable control account as a decrease in liability. As payable control account is being credited, I will record 20,000 on the credit side. The irrecoverable debts does not come to payable control account, because we will never be irrecoverable. If we become irrecoverable, our business is closed, then where we shall be passing our entries. So the irrecoverable does not come. Interest might come, that if we pay late to our payable, he might charge us interest. So what we will do, we will increase our liability, and by crediting payable, and debit would be the debit interest expense. That is in expense for us. So debit interest credit payable control account, that entry would be like this, but I have not recorded in this. Then again, we will close this account. To To close this account, we will total the credit side and total the debit side, and the balancing figure is to be recorded. 1,80,000 is the balance which will appear on the debit side of this account just to balance the credit side, but this is called a credit balance. As I told you that total the payable control account is a liability, and liability always has a credit balance, although it is as a closing balance it is written on the debit side. So this was the control accounts. So just to remind you guys, when it is these are prepared, when we have multiple type of one things, we can make a total account of all those things. For example, we have multiple suppliers, all those are payable. We have multiple receivables, all those are receivable. So we must know at some point of time that what is the total amount to be paid to payables and from to be received from the receivable, as well as we must know what is the individual amount to be paid to the one customer and the individual amount to be paid to the payable. So for those, we also make the individual accounts, but those accounts are not part of the double entry. Those are called memorandum accounts, but the control account becomes the part of the double entry, and this 180,000 balance of the payable control account will be written on in the trial balance. So this is how our lecture was. Please guys, if you guys have any query, any question, do let me know. You can discuss the question now, or you can discuss the question later on through WhatsApp